Good evening, everybody. I think, the last time we spoke a couple of weeks ago, there was a few things up in the air. It's been quite a lot of movement between now and then. And I think a lot of questions now are being asked about equity markets and stocks and, how solid is this rebound after one of the best rallies that we've seen in the summer for quite some time. The performance in July and August has been quite stellar. The bounce off the 16th of June lows, you can see here on the chart on the right, quite impressive. And then all of a sudden, some questions, some doubt about that. Based on around, I think, for what we're talking about is that central banks have restated their commitment to fighting inflation. And this is key to a lot of this. And I think the market realizes now that any idea of them moving towards a pause or pivot and actually moving rates back down again has been put well and truly on the back burner. Some of these moves down getting quite steep, further losses seen over the last few days. Traders and investors were nervous around the Fed chairman Jackson Hole's statement, and he was clear. He was very clear. It looks like control of inflation is the Fed's number one priority still. It always has been. It's just that the markets didn't really want to listen. And they are prepared to risk growth to get down to their objectives, which is close to 2%. Now, we may have peak inflation in the US, and some of the data suggests that. But, he is suggesting a sustained period of below trend growth may be required to get it to 2%. This is the difference. The difference between 2% and peak inflation is massive. So I think, they're clearly stating that a big increase in unemployment is going to be required to release the tightness in the labor market. And so now unemployment data is going to be really quite important going forwards. And don't forget, on Friday, on Friday, we have non-farm payrolls, unemployment data out of the US as well. So we can see some of the fading fortunes, some of these big billionaires giving back some money. No one minds seeing that, but it's affecting us all that are invested at the moment. And if we look at some of the percentage falls we've seen on the day of his speech, they were pretty big. You can see this list down on the right here. And we're seeing further losses this week as well. We're only into Wednesday, another weekday yesterday, another week session going on at the moment. And, it does just seem to me that there is quite a lot of tail risks out there that could continue to weigh on equity markets. So I actually think this rally that we've seen in stock markets over the summer has been a problem for the Fed. This is all part of what we call financial conditions. Now, the Fed wants to tighten financial conditions so that they can actually impact growth. They don't want a buoyant, confident consumer spending and sending inflation higher. They want the opposite. So if that means stock markets have to go down, then so be it as far as the Fed is concerned. So, this measure of stress across assets has not been anywhere near where they wanted it. And financial conditions actually loosened rather than tightened. So Powell dialed back on this quite aggressively on last Friday's statement and made it clear that the fight is still on and that they were prepared to go for longer than the market was pricing. So stock investors are now very concerned about not where peak inflation is, but how long it will take the Fed to get inflation back to target. And if we look at some of the survey data, we've got one here on the left, that belief is actually moving out. So to get to 2% inflation is still the key for equities. And at the moment, we're a long way off. Although CPI inflation has cooled, as can be seen on the chart on the right, and the last data we had. Having said that, some of the data just recently with jobs data that we've seen from job openings and things like that have actually been suggesting there's still tightness in the labor market. So maybe the Fed still has to go further. We're pricing around 50-50 between 50 basis points and 75, but the market is beginning to move closer to 75 basis points of a hike from the Fed just recently in the last day or so. So we've got private sector activity slipping in across the globe. And I think that is a good sign that things from the Fed are beginning to take some traction. And we're also seeing the housing market start to slump rather in the US as well. Again, something the Fed would be happy to see. So this is a start, but the problem is still tightness in the jobless market, in the jobs market. And I think, we haven't seen a massive softening in inflation, to be honest. There's pockets of it, but they will probably want to see more. We are getting some interesting moves in commodities as well. We've seen oil rallying whilst we've seen stocks fall, and then we saw that big fall yesterday. But I think one of the biggest threats to equities going forward is actually earnings. If we look back, earnings beat profit expectations in the last quarter, but looking forward, an awful lot of them are beginning to issue earnings guidance warnings going forward. And I think there is a real threat here, because I think margins are being hit very hard, particularly in small and medium-sized enterprises where their energy bills are literally wiping out all forms of profit that they could have been having. And I think this is something that has got to be analysed more. And I think we could see some shocks in earnings into the end of the year. So we need to keep an eye on that. But we need to get real with this, and we need to, there's an old adage, don't fight the Fed. And the Fed is taking back some of its credibility here. They're going to continue to hike rates. They've made that clear. And to my mind, they might actually have to do more rather than less. The problem is that we've got what we know as real interest rates still extremely negative. Now, this is yields, nominal yields, minus inflation. And if you take that, we end up with negative yields. And just look at how negative those yields are in Europe, UK, US, Canada, Norway. Rates are still very, very low. And real rates are what matters. And so, therefore, the Fed is going to, and the ECB are certainly going to have to do more, even more than possibly the ECB want to do. So, they can't fight inflation with negative real rates. They just cannot. So things are going to have to change. We actually heard from Fed speakers just the other day suggesting that negative real rates are a major problem. So, idea of cutting rates at the end of this year, or middle of 2023, just seems naive in the extreme, unless there is a major, major shift in unemployment data and inflation falling steeply. So, if we look at where some of the central banks are now, we've seen a very aggressive Royal Bank of New Zealand. They've got interest rates at 3% already. They probably are looking at doing another 50 basis points at the next meeting. We saw Bank of Canada hawkish doing 100 basis points at the last meeting. They're looking to do between 50 and 75 along with the Fed. RBA looking to do 25 to 50. Bank of England, Goldman Sachs came out the other day. I mean, a bit of a headline grammar saying, possibly inflation could be at 22% in the UK. I mean, again, inflation, it's strong. I mean, who knows? I mean, it could get there. It looks like a bit of a headline grabber to me, but the problem is it's rising pretty steeply, and the UK consumer is getting hit by all sides. If we look at that with interest rates rising, we need to look at tech stocks in particular. They are pressured by higher yields. We have to also say that technology stocks are sensitive to higher rates across the board, but bear market squeezes of 15 to 20% are common, and we've had one. The question is now, do we go back down and test those lows, or can we hold? And if you think we may have to go and test those lows and you're still long, maybe looking at some hedging or reducing positions is the sensible thing to do. Reassess the position as the data and the news changes. And to me, we've seen a fundamental change from 2009 to 2021. We had QE and low rates. That supported stock markets. That has now gone. Those days are behind us. So mega technology companies are unlikely to emerge unscathed from a general turn back down as well. Hedge funds reloaded longs at the end of June. They're exposed. I think there's a danger here that there are enough tail risks out there for a few people to start suggesting maybe I may take some off the table, keep some powder dry, and re-enter the market at better levels. And there's nothing wrong with doing that. I'm not saying anybody needs to get out of their positions or anything, or that stocks are going to crash. I don't think that. But there is a danger here because there are tail risks out there. So that's where the reality sits at the moment. And stock markets look a little bit vulnerable again. And I think, that there is enough going on to suggest a reassessment of one's longer term investment structures because the news has changed.